this is going to be a year of increased volatility, lower expected rates of return, 8 to 10% total return for the year. That includes dividends. Was probably what you should expect. And, be prepared for a 10, 15, even a 20% decline mid-year, possibly, based on some economic or geopolitical event, whatever it is. Markets are just extremely extended. They're overbought, exceptionally bullish. They are flush with cash, and they are just chasing markets in the most risky of areas. So, we're setting up for that same type of dynamic that we saw back in 2022, where the S&P corrects 10, 15, maybe 20%, but retail investors are going to get shellacked 40 to 50% because of the unwinding of that leverage.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of another week for another weekly market recap featuring my good friend, the prodigal Lance Roberts. Lance, how are you?
I'm good. I'm very good. I don't know about prodigal this week. I'm tired. It's been a busy week. I was in Vancouver last week, so this whole week's been catch up for following the conference. So
well, that's why I picked prodigal. Last week you were just too cool for school, too busy for us. You went off, did your own bright shiny thing. Now you're slinking back, trying to get back in our good graces.
Exactly.
No, anyways, good to have you back. In spite of the just avalanche of comments we had, which, we had Mike Leibowitz on in your stead, and they're like, why do you have that guy Lance here? This guy Michael's so much better and smarter and better looking. But don't worry, Lance, I was defending you against all of them.
Listen, I see the comments, and you are more than welcome to swap me out for Michael anytime you want.
No, Lance, look, and you're going to get a bunch of comments here of everybody telling you how much they love you. But anyways, glad you're back. Fair amount of things I want to talk about with you. First off, happy Valentine's Day to you and to your wonderful, lovely wife, who I got to meet the other week when you guys generously took me out to dinner. But I hope you're treating her well this evening.
Yeah, well, so it was funny. So she's been traveling all week. So she got a promotion at work. Has got a new job. So she was traveling up to Dallas all week, and she came home late Thursday night. So so we're recording this Friday morning. So she got home late last night, and she comes in and she says, "Look, honey," she says, "I love you. We've been married forever, and let's just not do anything for Valentine's Day. Don't buy me anything for Valentine's Day. We'll go to dinner on Saturday, but I haven't had a chance to do anything because of travel." And I'm like, "Okay, honey, no problem. I certainly understand that. No worries at all." Well, the problem is I'd already bought a big bouquet of flowers and a bunch of her favorite snacks, and had put together this whole thing for her. So this morning when she got up, but we get up about 4:30 in the morning. And so she came out to get her coffee. All this stuff was sitting there. She's like, "I told you not to do that." So wait, I already did it. So, and I figured it was a trap anyway. It'd be one of those things that if I didn't do it, she'd be like, it was like 2 years ago. Remember that Valentine's Day you didn't buy me anything? So, I figure better safe than sorry. So,
well, you're a good man, and you're setting the bar uncomfortably high for the slacker husbands like myself who are several steps behind you. But anyways, everybody watching, you'll be watching this, the day after Valentine's Day. So I hope you all had wonderful times with those that you care about in your life. The other quick announcement is, I'll keep this very brief. I'll give more details at the end, but the Thoughtful Money Spring Online Conference is coming up pretty fast now. We're about a month away from it. As a reminder, it's Saturday, March 15th. We've been having this steady drumbeat of new big names that we've been adding to the roster. This week's big name is John Thorndike, who's one of Jeremy Grantham's lieutenants over at GMO. And yes, everybody, I tried my best to get Jeremy. He's a very hard guy to get, was not able to get him, but was, again, able to get one of his top lieutenants. So yet just another fantastic name that we're adding to the roster. So if you have not yet signed up for the conference, you can go do so now over at thoughtfulmoney.com/conference. All right, Lance, there's a fair amount to talk about here. Very quickly, I got a chance to talk with Michael about this last week, but we've had some new inflation data come out. Markets, had a little hiccup when it came out. They've gotten over that pretty quickly. But the sentiment is still that we're going to be in stickier for longer, right? We've seen consumer inflation expectations spike, even though that's very dependent upon what political party you're affiliated with. Um, but anything to say about the inflation data one way or the other? In fact, I think I know you've got something to say because I saw a piece you put out there that said, well, when you look under the hood, actually, it doesn't look quite as
Yeah.
inflationary as one might think.
And it really wasn't. Again, we're when we look at inflation, so there's two things we always have to remember about when you're looking at inflation data. And again, you know, a, a little bit of what's sad is now the whole market is just driven to look at these 1 month numbers and then try to make all these assumptions based on a 1 month number. And, and inflation is very volatile to start with. If you look at a long-term chart of inflation on a year-over-year basis, it looks like a heartbeat. It's just all over the place, right? So it's these very volatile numbers. And secondly, when we take a look at inflation, you know, there's there's just all these kind of guesses at the number, and a lot of these things that we just don't know. And it's just trying to, because again, as we talked about before, my inflation in Houston is very different than your inflation in California. So, these are just guesses at things that are going on. But we have a lot of really short-term variable issues that are happening right now. We had avian flu, which killed like 100 million chickens. So we've got egg prices that are going up. Well, that feeds into inflation short term. You've probably seen the bacon, egg, and cheese sandwich index, which has had a big surge because of the price of eggs. But those are all temporary factors. And so as soon as supply comes back online, inflation on eggs will fall and we'll get back to some type of normal base for what's happening with eggs, as an example. When you take a look at oil prices, we had a very big spike in oil prices a couple of months ago, and that is about a 3 month lag into inflation. So that spike in oil prices showing up. Well, since then, we've had a very big drop in inflation. And so that's going to show up in
You
inflation.
mean drop in oil, but yeah.
A drop in oil prices, sorry, which will show up in weaker inflation numbers. But in this last inflation report in particular, the largest component, 44% of the index, is homeowners equivalent rent, which actually declined pretty sharply, along with healthcare, which is also coming down. So, we've got trends and major factors that are going to be driving the long-term trend of inflation, but we compare these things on a year-over-year basis. So, when we're looking at the comparisons from last year, when we were coming down really sharply in terms of inflation, it now looks like inflation's sticky because of the year-over-year base comparison, that base rate. We've got a little bit of unfavorable base rate comparisons coming up over the next few months, which is going to make inflation appear sticky on that year-over-year rate of change. But once we get past that, towards the end of this year into next year, inflation is going to start coming back down towards that 2% level. So again, that's just because of the economic dynamics. At the end of the day, whether it's short-term variable issues like weather-related events. One thing we saw in the inflation report was car insurance went up. Well, car insurance went up because you've had two major hurricanes in North Carolina and Miami, or Florida, sorry. And then you had wildfires in California. So all those cars have to replace. And when you have to replace all the cars and reinsure them, that drives the cost of insurance up short term. So these variable factors happen short term. But as the economy slows, as economic data slows, as wages decline, which are happening, and we can talk, and you've talked about the employment, what's going on underneath the terms of employment, that's all getting weaker, and that's going to drive lower rates of inflation as we go forward. And that's why you saw the bond market look right through both those reports on Wednesday and Thursday. Bonds have had a big rally because they're starting to see the underlying impacts of what's happening economically underneath. Retail sales report on Friday was a really good indicator of that.
Okay. Just because you mentioned it, so I did interview Michael Kantrowitz earlier this week, Hope Framework, and I totally dove into the E part of the Hope framework with him,
Right.
the employment side, and I got to say he's not as concerned as I thought he would be. I wouldn't say he's like super optimistic, especially about the jobs market, but I would call him kind of net, cautionary optimistic, cautiously optimistic. He's seeing some green shoots, definitely in the O and the P, in the order side and the profit side. And, Michael really peels through all the employment numbers, including the leading and the lagging indicators. And there's not much there right now to make him really nervous. Now, of course, I pressured him with a bunch of questions, and he sort of said, yeah, I mean, this could still go either way in a lot of ways. but I'm not seeing anything in my dashboard of many different inputs that I look at on the employment side to get real worried about this yet.
Well, no, and that's right. And if you take a look at, for instance, ISM services new orders, ISM services, prices over the last, like last 3 months, there's been a very big improvement in that. So when you look at that data, you go, well, there's really no sign that the economy is slowing down dramatically, and that's true. The economy isn't slowing. The economy is not falling off the cliff. It's a slow, gradual return to normality, which is a return back towards 2% growth. And we're currently running about 3% growth. So that's just going to grind lower. But we saw a big surge in activity over the last couple of months, right after President Trump was elected, because everybody was trying to front run tariffs. And it was also another big input into the inflation
Right.
and dynamic, which was this temporary surge in buying and activity that drove prices up. But if you took a look at, for instance, import and export prices today, import prices barely rose in the last month, because now we're getting the reversal of that. The latest ISM services reports show a big decline in prices paid, because now I've already bought my inventory. I've stocked everything up to get ahead of tariffs. Now I don't need to buy anything. So for producers to sell something, they've got to cut the prices. And so we're now starting to see the reverse of that. So over the next couple of months, if you interview Michael Kantorowicz again, say in say May, June, he might be a little bit more concerned. If the trends continue to kind of show up the way we think they're going to show up over the next few months, then I think he's going to be a little bit more concerned than he was in the last interview.
All right. Well, two things. One, I definitely will interview him again next quarter, but he brought this exact point up in the orders, saying, "Hey, some of this, maybe even a material amount, seems like it was done for tariff front running, and so maybe these green shoots aren't as green as they look upon initial viewing."
Right.
Um,
I agree
okay.
with that.
Yeah. And just to be clear, not that my opinion matters, but I'm going to take the under on the health of the employment market for reasons I'm sure we'll talk about. But I will say he's a better expert, obviously, on this. He's
Well,
an expert on this. I am not.
well,
Um,
no, I think I don't disagree with your view entirely. I mean, you take a look at what's happening with the JOLT survey, job opening labor turnover survey. Take a look at what's happening with continuing claims is a good example. So if you don't understand claims, when I get fired, I have to be fired. I can't quit,
right.
right? So I have to be fired or laid off. If I get fired or laid off, furloughed, I can go file an initial jobless claim. So that's the first time I file. Everybody pays attention to that one. Nobody pays attention to the fact that there's what's called continuing claims. And these are people that after their initial claim, they're not getting a new job and they're just continuing to file claims. That's a much more important, kind of market indicator than initial claims. So because there's a lot of stuff that happens with initial claims, but those continuing claims have been slowly rising, over time. And that certainly suggests that the labor market really is not as robust as a lot of these headline data says. Of course, we just saw these big revisions to data going all of last through 2024, just big monthly job revisions of jobs that actually never occurred. So you really got to take a lot of this data, on the surface, at least, with a grain of salt.
Well, yeah, I agree. And not that I wanted to get super deep into jobs here, but first off, you said, look, the economy is on a slow grind down, right? So that itself is headwinds to jobs. But the headlines, and I don't necessarily navigate by the headlines. You shouldn't navigate by the headlines, but the headlines for a good long time, a year and a half or whatever, have been increasingly filled with layoffs, hiring freezes, et cetera, stuff like that. We're not seeing, new plant hiring, 8,000 workers. We're not in that cycle of the economy here. We certainly have all the anecdotal evidence, which I keep hearing more and more in my life, of just how hard it is to find a job. And as I said, even Powell admitted that in his last press conference. He said it's a good jobs market if you have a job. It's a tougher one if you don't, right?
Right.
Quits are down, hiring rates down. But one of the things I don't hear anyone really talking about much yet is, well, two things. One, AI and its potential impact on jobs, but that's not necessarily going to be a 2025 story so much, right? Although we are seeing a lot of the AI, big Mag 7 AI companies continuing to shed people. Meta just, this week dropped another like 4,000 workers. So even these really big employers in the AI space are already starting to kind of, they're all talk about, they're starting to implement the like, okay, bottom 10% is going to get culled every year, all that stuff's coming on. But the thing I really haven't heard discussed as much as I think it deserves to be is what's going on the government side, right? The government has been, the growth in jobs has over the past couple of years has been pretty much 100% in government jobs and part-time work, right?
Yep.
And, not only is the government not hiring right now, but they're in a big, layoff mode. So,
Yeah,
you had
reductions are definitely coming.
yeah, you had the 2 million people that were given the buyout. 70,000 of them have taken it so far. There's another thing I just read this morning right before we hopped on here. I guess there's 200,000 government workers that are in their what do you call it? The probationary period. So like,
Right.
we've hired you, but it's kind of a test until everything, we all agree that you're good, and then you're like really here permanently. And those people have less, they're easier to fire for the government. There's less protections, regulations protecting them.
Yep.
So you're getting, somewhat of a chainsaw now going to the government workforce. We'll see how it all unfolds. And again, these people are getting presumably 8-month severances and stuff like that. So it's going to be a while before those people, get to the point where they're running out of income. But, that's for to me, that just seems like a predictable outcome here. And we should be talking about, well, what's the employment market going to look like, at the end of this year when all those people, their severance checks are done and they get out there into a cooling job market, and a lot of them can't find jobs. What's going to
Right.
happen to continuing claims? What's going to happen to the unemployment rate and all that stuff? So I feel like that's a shoe. I don't see how it's going to not drop in some way, shape, or form this year.
No, I don't disagree. I was just even talking to my son, who's he's in college right now, and he's studying computer science, and and we were just talking about his degree path and things that are going on. He's like, yeah, he says I've got a lot of. So he's in a business org that has a lot of juniors and seniors in it, and we were just talking anecdotally. It's like, well, when you get out of college, these are kind of things to look for. And he's like, yeah, he says I'm kind of worried. He says because a lot of my buddies that are seniors and graduating, they're going through these job fairs and things, and there's just nobody hiring right now. And they're trying to figure out when they got out of school, kind of what they're going to be doing for a living. And and so again, when we take a look at a lot of these numbers that are being reported, you know, it's a very different reality when you actually get out into the world of what's happening. And again, a lot of these people that are coming out of government, they're going to go to try to find work that necessarily isn't there. And again, as you were just talking about, you started this conversation off talking about AI. You know, as AI continues to mature and you're starting to see ads now, right? There was like an AI, I saw an ad just the other day talking about an artificial intelligence lawyer, basically. So if you need any type of legal
Mm-hmm.
work, this AI app will do all your legal work for you. Well, that's somebody's job. And we don't really think
That's
about that.
somebody's high-paying job.
Yeah, yeah. And that was
That's not
this.
replacing the fry guy. That's yeah.
Right. That's the point I was about to get to, which is, we don't think about this much, but when you and I were coming up and the internet was just really starting and the internet was becoming a thing and we all said, oh, it's just a fad, it'll never catch on. There used to be a time when you called a company and there was a person that answered the phone and said, hey, can I help you? Where do you want me to direct your call? Now you call any business you call, pretty much it's an automated service, except if you call my shop, there's still a real person there. Because I refuse to use the answering service.
Yeah.
I think
He's
I think
97
it's
years old, but there's a real person.
hey,
Yeah.
yeah, she's awesome, right? No. But no, the point is that was a job that was lost, and over time, we have lost entire slots of services and jobs that people provided, but those were all mostly lower paying jobs, right? And now we're starting to talk about an environment we're going into where all of a sudden AI can do engineering, it can do accounting, it can do legal, it can do oil and gas, it can do all these things that were normally high paying jobs. And so, what are those people going to do? And the thesis is always like, oh, well, they'll just go learn to program AI, right? And no, that's not going to happen, but this has a very different impact going forward. And again, we don't know what it looks like. We don't know how to model for it, but there's a real risk to, kind of what the future looks like over the next 10, 20 years in terms of employment and that makeup of employment within the economy.
So it's you're jumping to one of the bullet points I have here right before today's rant. And maybe what we can do is we can punt the rest of this discussion to there, but
Sure.
I'll just put a little seed here, plant a little seed here. So I interviewed this week Nouriel Rubini, And what's interesting is his moniker is Dr. Doom, right? And Nero Rubini first got on the map because he very publicly predicted the global financial crisis back in 2008 and was proven largely correct, right? So anyways, he's a big thinker, thinks about the future at a very high meta level. And two things in talking with him. One is in terms of kind of how he sees the world. I expected him to be a lot more pessimistic. I expected him to early earn the Dr. Doom moniker. I would call him like Doctor, like it's going to be okay, in the long run. But he was, projecting out where he thought current trends would go, and he said, "Well, first off, I think interest rates, like the 10-year Treasury, is going to be at 8% by the end of the decade. So in just 5 years." You may or may not have a different opinion. I don't want to get wrapped around that, Lance. But he said,
Sure.
I think that technology is going to be like AI is real. I think technology is going to continue to add huge tailwinds to economic growth. And he said, in about 20 years, he's like, it wouldn't shock me if America was growing at 8% a year, right? He thinks it's going to go exponential.
Well,
Kind of an interesting
and
debate
look,
about that. But let me just get to the key point, and then you can
okay,
react.
sure.
But he said, concurrent with that 8% GDP growth, I expect 80% unemployment. And this was all due to, the displacement of AI and other technologies and stuff like that. So we had an interesting conversation about what that would mean for society in that type of world, and love to get your thoughts. But if we can, let's get to the meat of the sandwich first, and then we'll end up with
Yeah. But remind me of that point about 8% growth, because that's, when you talk about 8% interest rates, in order to have 8% interest rates, you've got to have 8% growth, and you'll have 8% inflation, because they all correlate together.
Mhm.
So, and that brings up a really interesting conversation we'll have to have, is like, great, how are you going to get 8% inflation, which is all supply and demand driven, if you've got 80% of the workforce unemployed? Where are they getting money to spend? Right? Because you have to produce something in order to consume, and consumption is what creates inflation. So if you're out of a job, how do you consume? And so it's going to be an interesting question, because that means the government's providing everybody money to live on.
That's where he went. Yep.
Right.
And then I had questions about that. But okay. So let's get back to the market part of the weekly market recap. All right. So stocks have kind of largely been stuck in a trading range since the end of last year. They've been ping-ponging back and forth. The day we're talking here, at least when I started writing my notes, they were kind of near the top end of the range. Sounds like maybe you think we're in the process of a breakout. I don't know. But why don't we pull up the technicals, and why don't you show us where we are?
Sure. Yeah, I know. I jumped the gun on you. We broke out of a trading range this past week, but we're not out at the top of the longer term trading range. So yeah, to your point, depending on the time frame that you're
Okay. Well, and look, and while
talking
you're
about.
bringing up your chart here, let me
Yes.
just throw in a recent headline from Goldman.
Yep.
This was to one of their client notes. A number of people that I've interviewed on this program recently have said, look, 2025 is looking like it's going to be a much more volatile year. We're probably not going to get a big 20% return like we've had the past 2 years in the market. You and I have talked about both of those things already. Goldman seems similar, and what they're actually saying is sell the rips and be ready for dips.
Yep.
So they're
Absolutely.
sort of skeptical about a material breakout here. They think that stocks are going to keep getting knocked back down into the trading range when they get high. So, anyways, if you have any reaction to that, include that in your
Yeah,
answer here.
that's not exactly what that means. I can break. So by the end of this year, the markets will likely be higher than where they started the year. But along the way, you're going to have nice rallies. And for instance, we've had a very, very nice rally since, we had an early sell-off, coming out of December. The Santa Claus rally failed. We were, kind of struggling in the first few days of January. Then we sold off. So we kind of had all that going on through the first half of January. And since then, we've had a very strong rally since the actually inauguration of President Trump. That's really what started the rally. And we've had a very nice rally. We're sitting back at all-time highs. Likely sometime between, we'll probably hit new highs in the next couple of weeks or whatever, because the buyback window for corporate buybacks just fully reopened this past week. So we're going to have about $50 billion worth of corporate buybacks coming in between now and the next earnings cycle. Once that window closes for next earnings season, it wouldn't be surprising if this summer we saw a 10-15% decline, kind of like we saw last summer. And then you buy that dip, and then you get a rally to the end of the year, which potentially sets you back up to all-time highs. So again, Goldman's probably very right, is that you want to kind of be a seller of rallies and a buyer of dips, and that's going to be very hard. And I think this year, as I wrote earlier this year an article called "Curb Your Enthusiasm." That was the kind of the basis of these conference speeches I've been giving over the last couple of weeks. Is that this is going to be a year of increased volatility, lower expected rates of return, 8 to 10% total return for the year. That includes dividends. Was probably what you should expect. And be prepared for a 10, 15, even a 20% decline mid-year, possibly, based on some economic or geopolitical event, whatever it is. Markets are just extremely extended. They're overbought, exceptionally bullish. And kind of part of the analysis that I went through on Tuesday and on the website was just looking at retail investor sentiment. They're piling into leveraged ETFs at a rate higher than what we saw back in 2020, 2021, which is pretty amazing because back then they didn't have rent payments, they didn't have student loan debt payments, they got moratoriums on their mortgage payments and rent. They would get $1,500 checks. They couldn't go anywhere, so they were all gambling in the stock market. They were all buying levered ETFs and options, et cetera. That level of money flow into those markets by those retail investors is now even higher than it was then, which is pretty incredible. It's like, where's all the money coming from is kind of a big question, but they are flush with cash and they are just chasing markets in the most risky of areas. So, we're setting up for that same type of dynamic that we saw back in 2022, where the S&P corrects 10, 15, maybe 20%, but retail investors are going to get shellacked 40 to 50% because of the unwinding of that leverage.
Okay, so it sounds like kind of the takeaway here is from you, Goldman, et cetera, is don't get suckered into being speculative on the long side in a year like this one. Instead, embrace the roller coaster.
Right. Yeah. And again, it may not be this year. I mean, literally, we could run this whole year in a very low volatility trading range. That's the subject of this weekend's newsletter, which is the instability of stability. And over the last 2 years, we've had a market trading within basically a 1% band. So, you look at the market, it's got a big up day, we're up 1%. The market's, terrible CPI report, right? We're down 1.5%. We're right around that 1% band on the downside. DeepSeek comes out, we're down 1.5%, and close the day almost back to flat. So very low volatility trading range over the last 2 years. So when that stability ends for whatever reason, you're going to get bigger moves in the market. But that might be next year. It might be where we kind of keep running this market through the end of the year, and then kind of starting in January of 2026, it's kind of like a January 2022 thing where we started out, Russia invades Ukraine, and then the whole year kind of sucks. But we don't know when the trigger date's going to be. But that's why it's really important to pay attention to cash flow, our money flows into the markets, which is why on this chart that I'm showing you right now, that green shaded area in the background is money flows. And you can see that starting back, and so remember, when you and I were having this conversation back in November, we said, hey, be very careful going into December. Everybody was very optimistic about the markets. We said, be careful going into December because we've got end of the year rebalancing, right. We've got mutual fund distributions. That's all going to take money out of the market. Well, that's that green shaded area. And you can see that that green shaded area started declining right around that second week of December and went all the way through January. So that was that distribution and rebalancing of portfolios and kind of re-putting risk off the table. Since the middle of January and going into the inauguration, you can see since then, those money flows have surged to a very, very high level. And so we're at a peak money flows. Money flows don't normally get much higher than where they are right now. So I would expect that over the course of maybe, the next 2 weeks to maybe next 3-4 weeks, we might see a period of weaker money flows coming to the market. And that's going to start hindering the market's ability to continue to run higher, at least short term.
Okay. And to your point about thinking it's peaking or near a peak, are you judging that mostly just on where it's been in the past, or are there actual flow reasons?
No. If you just if we just kind of take a look historically, again, it'd take me a minute to adjust this chart, but
yeah, but we can see the green there. Yeah.
Yeah,
So,
but
I mean, it's about as high as it's ever been. Yeah.
right, and through good times and bad times, it's these kind of peak levels, they just don't normally get much higher than this. Doesn't mean it can't go higher. I mean, certainly things can, but normally this is kind of the point to where markets start to struggle here. And again, it doesn't mean that the market falls apart and you have a 20% correction now. It just means that we might grind higher here slowly, and then money flow kind of comes out of the market a bit. You get maybe a little 5% correction, this type thing, and then we run back up again. And again, it's that volatility kind of going on in the market. And just kind of wears investors out over time, because you really don't make a lot of progress. You just do a lot of churning.
Okay. So here goes to my next question, which is really about kind of, your process and how you're planning on surfing this year, I guess is a good way to think about it. We've got three things I think we've already mentioned here, right? We've got a slowing economy, not like, hitting the brakes, but just sort of slow grind, as you said. We've got an expectation of lower gains in the market than we've had in the past couple of years, right? I kept using that analogy of your team winning the Super Bowl twice in a year, and then you're hell bent on a three-peat, a dynasty, and you're super angry even if they have a great year but don't get the championship ring. And then of course the Chiefs came and did exactly that, right?
Right.
You're a Chiefs fan, you feel like it was the end of the world, and it was like, hey, they made it to the Super Bowl. They just didn't win a third Super Bowl in a row, which is almost statistically impossible, right?
Right.
So we're kind of looking at one of those years in the market right now, and it seems like we're going to have a lot more volatility. Right.
Right.
So Lance, you have, billions in client capital that you've got to shepherd through all this. How are you and your cohorts there, like Michael, thinking about, okay, this is going to be a different year, it looks like, than what we've had in the past 2 years. How are we changing, if at all, our investment strategy?
Well, it's kind of, using the football. There's no change to the investment strategy, right? So, and you should, and if you're ever changing your investment strategy, you don't have one, right? Because your investment strategy should never change, because the strategy that you build. And I did a whole long segment on the Real Investment Show a couple of weeks ago talking about, if you're an investor and you don't have what's called an investment policy statement, you should not be investing your own
Right.
capital,
We talked about this earlier.
right?
Yeah, and I totally
Right.
agree.
And if you go, well, what's an investment policy statement? You should not be investing your own your own capital until you find out what one is. But basically, you need to be able to write down, why do I buy a stock? Why do I sell a stock? And have everything written down. If you can't write it down, you got a problem. So that policy never changes. And using the football analogy just for a second, it's just a great analogy when it comes to managing money. If I'm a quarterback, my goal is to get the ball into the end zone. Now I can do that two ways. I can throw Hail Marys every single down. I throw a Hail Mary for the end zone. Most of the time I'm not going to connect, and probably more often than not, I'm going to wind up getting intercepted at some point. And that's not a great way to score touchdowns. The best way to score touchdowns is an inch at a time. If I can just keep moving the ball, 1 yard, 2 yards, 3 yards each down, and just keep grinding away, get those first downs, then go for the next first down, then go for the next first down, and just keep moving the ball down the field and do it successfully, I'm going to score more often than not. Same thing in baseball. You can use baseball analogy. I can win. I don't have to hit home runs every single time at bat. If I can just keep hitting consistent singles, I'm going to drive runs in, right? I can win the game. It's the same thing in portfolio management. It's not about big moves. It's about making small moves and small adjustments along the way. Just keep moving the portfolio forward and then managing it for the relative risk in the market. So a good example is this past week, we looked at our portfolio, and we have some positions in our portfolio that are just have grown to just be exceptionally overweight. Costco is now up more than 100% from the time that we bought it. So we just trimmed that back to target weight. We've got a lot of positions in our portfolios that had, were, 0.5% or 1% or more outside of their target portfolio weight. So we just trimmed, Walmart, Costco, Procter & Gamble, just kind of trimmed those back to their actual portfolio target weights, took those profits, and are just holding those in cash right now. And so when we find the next really good opportunity, we have some cash to put to work. But if something comes along and impacts that stock temporarily, we've already taken profits out of it, already reduced the risk. And so those are companies we're going to own forever, probably. And so if that stock gets hit, takes a 10% pullback at some point, we're going to take that cash and stick it right back in and buy those shares at a reduced cost. And that's what we've been doing with NVIDIA. Ever since we bought NVIDIA, we've had NVIDIA run up dramatically. We've continued to just sell that position every time it keeps running up, and we no longer have any capital in that position. It's just all profit now in NVIDIA. And that's kind of the same way with a lot of these stocks, is that we just kind of just keep buying and selling them all along the way, kind of reduce that risk, rebalance the portfolio weight. But that way, when the market does decline, we don't have to, the portfolio doesn't decline as much as the market, and it's going to go down, right? If the market goes down, our portfolio is going to go down, but the goal is not to go down as much as the market. And we've already been harvesting all along the way. So we just kind of have a lot of cash sitting there usually to go and make opportunistic buys into markets. So sell the rips and buy the dips. And it's a strategy that will work very long over the long term.
Okay, so very helpful to hear. But sort of the spirit of my question, so let's say it's 2024. You're coming off of 2023, a great year 2023. Still got the same vibe, right? So you have one type of portfolio allocation for that, right? And it might be, as you've said, I think in 2024, hey, we brought our allocations up to maximum, right?
Yeah.
Whereas in a year like this, you might say, well, maybe we want to have a little bit extra cash coming in just because there's more uncertainty. That's just an example. I don't know. But my question is are you making any sort of changes like that given your outlook for the year?
Now there's the interesting question. So yes, now we're not doing anything yet because we don't have the full signal in place yet. But so I just wrote so I didn't write a newsletter this past weekend because I was traveling. So I updated all of our market statistics on Tuesday in our report. One chart that we don't produce on a regular basis is this chart. And this is our risk management chart. This is what we use internally to manage how much exposure we have to markets at any given time. So this relates specifically to the equity allocation in a portfolio. So if we have portfolio models all across the range of allocation from 100% equity, our dividend equity growth model, 100% equity, all the way to just purely fixed income models. So 20/80s, 60/40s, 40/60s, 80/20s, 100% equity. So depending on your allocation model, what I want to know is how much equity risk should I have in the markets at any one time. And so we're looking for specific trigger signals to take that equity risk down either mildly or sharply. And when these trigger events occur, they reduce portfolios rather dramatically. So we kind of work in 25% increments. Now, and what's important to understand is that our portfolio will never go to 0% equity. And this is an important understanding because the problem with going to 0% equity is that it's very difficult to get back into the markets. And so our portfolio, so let's just use our 60/40 allocation as a good example of this. So at maximum exposure, I can actually have 70% equities and 30% fixed income. And markets are, so in 2023, we were actually overweight equities, and going into 2024, we were actually overweight equity relative to our target weight of 60/40. So the portfolio has some flexibility to it to take advantage of bull markets without dramatically increasing the risk to the overall portfolio. But and now we're at target weight. So we're currently running a little bit under. We're about 58% equities right now. So we're a little bit under our target weighted allocation, but that's just a function of harvesting profits and those type of things. So that's going to adjust a little bit. But once the trigger set in, and we actually have a trigger that, and again, part of this is money flows I was showing you a second ago. Once we get a trigger in that says, okay, we need to reduce equity risk, we reduce that by 25%. So in a 60% allocation of equities, 25% of 60 is 15%. So we would go from 60% equity to 45. If the second trigger occurs, we go from 45% equity to 30% equity. The third trigger occurs, that takes us down to 15% equity. Now, we never go below 15% equity. Now, we can hedge that off, we can short the markets, we can effectively get it to zero, but we will always have 15% exposure to equities. And the reason for that is now those will be deep discount, value oriented, good, solid companies that are paying a dividend. They're sitting in that 15%. The reason is psychology, because once the market bottoms, like we did in 2008, and the market begins to recover, investors are going, man, I don't want to own equities. This market's going to zero. Haven't you heard the world's ending, blah, blah, blah. And the market starts to recover. Well, once you start to see that 15% in your portfolio begin to recover, it's much easier to start adding back to that risk in your portfolio than it is to go from zero to something. That's the hardest thing to do. And this is why there's a lot of investors out there today that are still out of the market since 2008. They were never able to get back into the markets. That's a very tough thing to do. So, and think about it this way. If I only have 15% equity in my portfolio and the market goes down 10%, my portfolio is down 1.5%.
Right.
If it goes down 20, I'm down 3. See, that's very easy to recover from versus going down 30, 40, 50% in your portfolio because you've got too much equity risk. So that's a long way to explain what this chart does. So right now we've got 2 of our trigger signals in. Now there's 4 altogether. Money flows is not on here. That's a separate indicator that we look at. But if you'll notice this long-term trend in the markets are currently trading at the top of this long-term trend channel that started back in 2009. Historically, we've been at this level. It can stay here for a while. And again, just like we saw in 2014, 2015, 2016, it can stay at the top of this channel for a while, just kind of run along the top of it. In 2021, we actually ran well above it until 2022 came along. But we're at the top of that channel. So that's kind of a trigger warning. It says, hey, you know what? We need to be paying a little bit more close attention to what's happening in the markets. The 2 signals at the bottom are long-term moving average convergence divergence indicators. They are trying to trigger sell signals. They're flipping back and forth right now, so we don't have a confirmed sell signal yet. But once those 2 confirm and break that signal, that's going to be the first time that and again, with that trigger, we should also see money flows declining. That will begin the reduction of risk from 60% equity to 45. We're not there yet. That could happen this year. It could happen next year. But we've got some potential buildup in the markets that once we start getting those confirmations of sell signals actually coming into place, then we'll begin to more aggressively reduce exposure. But this is part of our investment policy, this whole risk management process. And it's complicated, I know, but this is what we work around as a basis for understanding how much risk exposure we have to markets.
All right, super useful. And we'll be referencing this then throughout the year, Lance, just to see where we are in the triggers.
This is proprietary.
So this is the secret sauce. Yeah.
So, yeah.
All right, everybody, you're getting the insider's view here. So, sorry, bring it back up just for 1 second.
Sorry.
And if the answer is it's proprietary, I'll understand. But
it's proprietary.
Okay, so the bottom 2, all right, I understand that they're a moving average of convergence, divergence metric here. What goes into these?
Right. So I won't tell you this. I won't tell you that part because this is really, 25 years of my life that I worked around building this. So there's some very special settings that we use. These are basic MACD indicators. So if you can build a MACD chart onto a, like stockcharts.com or whatever charting system you use, you can build a MACD chart. I will tell you that these are weekly data points, so they're very slow to move. This is not daily MACDs. I won't give you the actual settings, but you can play around with it and probably get pretty close to it using your own settings. But this was what works for us and managing our money.
Okay. So just to reiterate here, I mean, I know there's a whole bunch of other things you look at too, credit spreads being, one we've talked about a lot, but
that's
kind of your big 4 here for making the decision of do we change the allocations of our 60/40 buckets are money flows, whether you are out of the channel that you have there in that first top graph, and then, what the two bottom indicators are telling you.
Right. So there's in order of preference, right? So technicals are first. Do I have technical sell signals? Am I breaking? And they're kind of hard to see on this chart. Maybe I can zoom in a little bit. You can see that so moving average indicators are a function of moving averages, right? So you can see there's this blue and this orange line in here. Those are the weekly moving averages that feed into those MACD indicators. So the first thing is are we breaking moving averages? The answer is no. So that trigger's not in yet. But we're getting pretty deviated above the longer term moving average. So that's kind of a warning sign along with being at the top of the trend channel. Second thing is that these MACD indicators are flipping back and forth right now. So we don't have a confirmed sell in those indicators yet. So that would be the second trigger. Third trigger is money flows. Fourth trigger is credit spreads.
Okay.
So those are the four kind of in order as we start triggering each one of those. And once you start to see credit spreads begin to rise rapidly, that's where you want to have the least amount of equity risk exposure in your portfolio.
Okay. And just since we mentioned them, what's happening with credit spreads right now? Are they still pretty tight?
They're nothing. They're dead as a rock.
Okay. All right.
It was funny too, because we're in the process of launching a private credit fund right now. And I was talking to one of the private credit managers that we're working with on this fund, and he said the same thing. He's like, right now, he said there is no spread. He says if you're an investor in bonds of high quality, if you're buying high yield junk bonds or sub investment grade credit bonds, you're not getting paid for the risk that you're taking for that yield. And he said that's a very unusual environment to be sustained as long as it has been so far. We've had a very long period of very, very low credit spreads where basically it doesn't matter what happens in the world, bankruptcies, defaults, whatever, credit spreads aren't moving. There's just so much money. And again, this is the whole market, right? So this is, gold as a good example. Gold is trading above all of its fundamentals. It's trading above monetary, where M2 money supply is. It's trading well above inflation. It's got 100% correlation right now. It's got the highest correlation on record to stocks. The last time it was this highly correlated to stocks was in 1980, which you don't want to remember what happened with gold after that price. But we've got so much money chasing assets. It's chasing gold, it's chasing stocks, it's chasing Bitcoin, it's chasing any asset, high yield junk bonds, et cetera. So it's just money's just piling in to wherever money's being made, there's just a wave of money just chasing it. And there's just so much supply of money. There's just simply not enough assets to buy. So money's just pushing every asset class off to the moon. So when you get the next reversion in money flows, it's not going to be a segregated event where, stocks go down and gold goes up. It's going to be everything gets blasted. And you want to be in cash and long duration bonds. That'll be the only place you want to be.
Okay. Well, I'm going to have a lot of questions from folks as to, all right, Lance, so when does it look like we're close to that moment? But
no, the question is, I have no idea. It could be a year from now. It could be 5 years from now.
Right. And that's why you have your indicators that we're walking through right now. All right. So 2 questions around this. One is just, so, you just mentioned that you're starting a new private credit line of business. Do you feel a little bit like you might be tempting fate coming in when the tide is that high?
No. The private credit is a very different animal. I've been dealing in private credit personally for 10 years now. Private credit's a very different animal over the public credit markets because in private credit, you don't have the public flow of capital, right? So, what drives prices up and down in asset classes? And so if I'm long, say I'm long the S&P, if money flow runs out of stocks, then the price that goes down, right? Because it's always a function of buyers and sellers.
Right.
Same thing in the public credit markets. If all of a sudden nobody wants to buy, a debt instrument, the price goes up, and because the price goes down and the yield goes up because they're going to find a buyer. Private credit markets are very different from that because, again, generally, like when I'm doing private credit now, I've got 80% loan to values. I've got, You know, in some cases, I've got 100% loan to value. I've got asset collateral sitting there of some sort where if they fail to pay, I'm just going to go sell the asset to the market and get my money back plus a profit. So it's a much safer way to invest, and it's a much better way to generate, you know, higher yields. You can generate higher yields over time by, you know, through private credit, and then also in distressed real estate, those type of things. There's good opportunities there.
Okay. All right. Well, look, when that thing gets up and running, obviously, we'll let you tell everybody about it here for, you know,
Sure.
whatever investors that might make sense for. I just also wanted to note here too. So I interviewed Michael Kantrowitz, as you said, and as I mentioned, you know, he's sort of, you know, a little more optimistic these days, economically. Markets wise, he's just like, look, there is no risk priced into this market.
Yep.
And so, you know, it's one of those things where, like, you know, you got to remind yourself that the economy and the market technically are two different things, right? And you can be bullish on the prospects of the economy, but be very nervous about where stocks are simply because valuations can be too overstretched. And he does believe right now, as the gentleman you talked with, that there's just so much money sloshing into everything right now that there's just no appreciation for risk.
Yeah, no, it's the most phenomenal thing. I mean, you know, it's just, you know, I did an M&A conference. There was a mergers and acquisitions conference back in 2021, and this was probably around April of 2021. And this, of course, this is right after, you know, the government's just sending checks. We got all this money coming in, blah blah blah. And I went to this M&A conference, and they're like, man, M&A is just booming. There's this literally money laying around in the gutters. If you've got a business at all and you want to do M&A, it doesn't really matter what the quality of the company is, there's money to do it. And then, of course, and I was like, well, whenever I hear that kind of stuff, it's like that's kind of like a big warning sign for me.
Yeah,
Right?
that's a Wall Street shoe shine
Yeah,
boy from the 20s.
exactly. And so I was like, okay, well, that's fine. Well, of course, 2022, that all fell apart, and all those M&A deals just completely collapsed in 2022. But that same sentiment is now back, and again, it's just interesting because, you know, just there's even more money flowing into the system now than we had before, and again, you've got higher interest rates, right? The Fed's doing QT, you know, and you know, everybody's back to having to pay all their bills. You got to pay your student loan bill now. You got to pay your rent. You got to pay your mortgage. You're not getting forgiven on all that stuff.
Right.
And there's just,
Fiscal austerity has all of a sudden become sexy, you know, in the
yeah,
government.
and yeah, the money is just rolling in. I mean, if you're not making money in this market, you need to seriously rethink what you're doing, because, you know, pretty much you can throw a dart at anything and you're going to make money. This is, and to be honest, Adam, you know, you'll remember this. This market right now reminds me a whole lot of 1999, because back then you could literally just throw a dart at pretty much anything and it would go up. I mean, I bought positions, you know, 3 months ago. They're up 70% now. I mean, it's just stupid.
Yeah.
Right.
So
Does
this make you nervous that, you know, so, you
yeah,
know, one would say, oh, Lance is, you know, he's got to be loving life. But does it
makes me
instead
nervous
make
as
you
hell.
sleep hard, make it harder to
Yeah.
sleep?
No, it doesn't make it's no, well, yeah, I guess it does. It makes me nervous, right? Because I know this can't be sustained long
Right.
term, right? And the problem is twofold. So this is the interesting challenge, and you know, I was doing our YouTube show earlier this week, and a guy said, "Well, you're just talking your book." I go, "Yeah, of course I'm talking my book." Anybody who's talking about investing is talking about their book, because that's what they believe in. I don't invest one way and believe another way, right?
Right.
So
It's the
it's
way
like,
you see the world. Yeah.
right. I'm going to put all my clients into stocks, and I'm going to be sitting over here in cash, right? That's just not the way it works. Um, but you know, I'm challenged by that fact that, you know, inherently in my nature, I know that what's happening in the markets is not healthy, right? And this is eventually going to have a consequence. But if I just go to cash right now and just sit in cash, I won't have any clients if this thing continues to run for a year. So,
Right.
and I'm not doing the right thing for the client. My job for my clients is to make sure we're meeting their return goals every year so they can fund their retirement. So, you know, I've got to be invested, and, you know, we have portfolios across all kinds of risk, you know, spectrums, whether it's super conservative or super aggressive. Um, and so, based on what their return goals are, I've got to manage money to reach those goals. So when there's a lot of excess in the market, excess optimism, excess, cash flows, those type of things, it certainly makes me nervous because I know at some point the market's going to trip. And I've got to be prepared to react when that occurs. But that's the real challenge. If you're trying to be proactive and you're too conservative, you're going to wind up giving up a lot of returns. If you're not proactive and you don't react either, then you get hurt by the crash. So it's a real fine balance between being a proactive manager and being a reactive one. And that's why, when markets are running up, we take profits, we reduce risk. That's some proactive behavior. When we start getting the signals, that's when we become reactive, and that's when we start taking big chunks out of the portfolio very quickly, like we did in 2020.
Okay. I probably shouldn't do this, but the analogy that's coming to my mind as you're talking about this, the majority of folks that view this channel are men. So that maybe this is just the way the male brain works. But this is sort of like, you're at the bar and this woman who is so totally out of your league is showing a lot of interest in you. And, you start dating her and you're just so thrilled. You can't believe how great you are. You're showing her off to your friends. And of course, the danger here is you've somehow just told yourself, look, I don't understand it, but it's the best thing in the world and I'm all in. And then, one day you come home and she's gone and, all the possessions of your house is empty. Your bank account's been drained, right? Like that's the danger, right? When it's just too good, right?
Hey, trust me, I've been married to that for 15 years and I keep wondering every day if I'm going to come home and the house is gone. So
Yeah. No, I'm not going to let you describe your wife that way. She's wonderful. But yeah, I mean, just we kind of know sometimes when it's too good for who we are, right? It kind of feels like you feel like, yeah, but it kind of feels like you feel like that's the market we're in right now, right? Where the market is it's just treating me too nice, right? This can't last. Yeah.
No, and it really is. And, we get and that's really kind of to strip everything back to the basics. Markets investors today are too complacent, and they're too complacent in every asset class they own. If you're long 100% gold and you think that's the place to be, awesome, but they're too complacent in that asset class.
Well, wait a second, Lance. But Bitcoin's accepted from here, right?
No. Investors are very complacent in Bitcoin.
I was making a joke.
I know you were. But no, I know you're making a joke, but no, it's true. I mean, because you take a look at the correlations of these asset classes, they're all trading near one, which means that everybody is super complacent in basically every asset class. And so when that complacency turns, and see, that's the risk, and this is the whole point of the stability instability paradox, is that paradox is that being, everything's great, right? It's stable. We're no concerns about risk. That's the very basis of what creates instability in the markets. And so we're building the base. We're basically building. We're going to start a fire. We're putting all the logs, the tinder, the accelerant. I mean, all we need right now is a match. Yeah. All that complacency across all those asset classes have now mounted up to this very high correlation. So when one thing goes, it's going to take everything with it.
Okay. I will say it's interesting hearing you say that and also seeing that you don't yet, I know you're watching the triggers carefully, but you're still sort of 100% allocated equity, right? Because I hear a lot of concern, and I know this is your job as the portfolio manager, is to say, look, I got to have a process in place that I just can't let my emotions dictate me, because I got to trade the markets the way they are, and sometimes they can stay the way they are for a lot longer than you can imagine, right? So I got to imagine you've got to be feeling some cognitive dissonance right now of like, hey, look, my gut is really sending out warning bells, but I'm still not changing my playbook dramatically yet.
Not dramatically, but these are the conversations that Mike and I are having. I mean, just this past week, like I said, we started just rebalancing positions that got really overweight back to target. The next step, and probably something we'll do. So, like for instance, in our dividend equity growth model, we've got a lot of positions. Meta has been on which is one of the positions in that dividend equity growth model, has been on just a tear. It's been like 19 days of positive returns. It's one of the longest streaks on record. That stock's supposed to be 5% of the portfolio. It's almost 6 now. So probably in the next week we'll rebalance the whole portfolio and rebalance some of those positions and just put some cash into some other places. We have a portfolio that has gold in it, and gold has become a very big chunk of that portfolio, very far outweighted outside of its target allocation. So we're going to probably wind up reducing that position somewhat back to target weight. But those are those actions that we're talking about right now. So those are the proactive actions. And right, so we're being proactive about the risk, rebalancing the targets. We're looking for things that are grossly underperforming, selling losers and laggards, keeping our winners in place, letting them do their job because that's where money flows are going to. Then the reactive part will come is when we start seeing the market break. And so when the market breaks, that's when we just start indiscriminately kind of selling. 25% of every position gets sold. The next one, another 25% of every position gets sold. And so then that's where you have very large sales. And again, this goes back to early 2020. In January 2020, we were having the same conversation. The markets were extremely extended, very overbought, super exuberant. There was no risk on the horizon. And we were like, and I wrote an article called This Is Nuts. I said, when you start your portfolio management meeting with This Is Nuts, it's probably time to start taking some action. And so we were reducing portfolios in January. We reduced them in February. And then in early March, just as the pandemic hit, we got the first trigger signal and we started reducing equity risk very rapidly at that point. But we had already reduced a good bit of risk out of the portfolio before March ever hit. So we didn't have to, just violently sell everything during that whole March decline. So that's kind of the process we're in now, which is that proactive part, which sets us up to be reactive, but we don't have to be dramatically reactive because we've already taken some action. So we can let the market break a little bit, confirm that we've got an actual break going on, confirm it's not just a little quick sell-off that reverts. But once we start to see those signals all kick in, then we can more safely just start reducing broad chunks of risk across the portfolio.
Yeah, analogy here might be you're not hitting the brakes yet, but you're lightening up on the gas so that if you decide you need to hit the brakes, you're at least hitting them at a slower speed. You're not going, jamming on that one you've just been going.
Great analogy. Yeah, great analogy.
Okay. All right, I got to move on here just because of time. So we could talk a lot about this. Let's just try to box it into a couple of minutes. We can go longer next week if you want. But okay, so we now know more about Trump's actual policies. Most of his appointees have gotten approved or look like they're going to get approved here at this time. So we kind of know what we're gonna get this year in terms of approaches. I mean, I know the guy throws like 5 different curveballs every day, so there's still going to be a lot of surprises. But we kind of have a sense now for the main pillars of the policy. Does this make you more, less, or no difference in terms of your kind of expectations for the economy going forward?
Well, so I guess you kind of have to focus in on specific actions and their impact to the economy. So I just wrote an article on Friday talking about tariffs.
Right.
Tariffs are not as, they're like, oh, tariffs are inflationary. Actually, they're not. And there's reasons for that. And, but tariffs do lead to increased market volatility, which we lay all that out in the article. So we kind of go through tariffs. And so tariffs certainly have some impact to markets, but not what a lot of the media makes it out to be. Most of the media, their views are wrong about tariffs, and we have history to look at to tell us that. But now you start talking about kind of what's going on the DOGE side of the equation. Well, reducing deficits are not good for markets or the economy. Deficit spending increases economic growth because that's where that money winds up. So they're talking, they're already doing some pretty radical cuts to spending. And again, we were talking about, $59 billion with USAID at this point. So, that's a rounding error in the money we're spending, right? But if they actually start getting to, several hundred billion to $1 trillion in money that we're not going to spend going forward. Again, this is just eliminating programs. So it's not that they're drastically cutting spending. They're just basically saying that money we spent on fraudulent payments or whatever it was before, I'm just not going to make those again. That's going to slow economic growth. So this goes back to, economic growth, inflation. That's all going to go lower if you start cutting the deficit more. So you have to really kind of define on, say, okay, well, these are the policies he's doing. What's going to be the impact of that? Because some impacts are positive, some impacts are negative, and it depends on where that impact is falling.
Well, sure. And I've asked the version of this question is, can Trump be successful with this stuff without short-term disruption? And I think your answer and most people has been, no, probably not, right?
Right.
But a couple of things. First off, I mean, just putting it all together as best we know now, does it make you a little more bullish or a little more bearish about where the economy is headed?
So I think the real answer to that is it makes me a little more bearish on the economy short term, because I think these things potentially do lead up to some sort of short term disruption in terms of spending, and that's going to slow economic growth. So a little bit bearish, near term on that. But if he achieves what he says he wants to achieve, and we get a lot more transparency, and we clean up a lot of the spending that's going on, then that's actually good for the economy long term, because we'll be able to allocate more money to more productive investments. And again, because you look at a lot of this money that's getting spent, it's just getting wasted. It's not even, we're taking taxpayer dollars and sending them all around the world.
Right. And so that's the DOGE side. I don't think anyone really can argue, against the benefits of being more fiscally
right. And I'm just saying, but I'm just saying, if we take, just say for instance, we took $20 billion that we were sending to some foreign country, and we spent $20 billion on solving homelessness, right? That's a benefit to the U.S. economy, right? And that's why I'm, that these policies are more bullish long term, but near term, the reduction of the deficit spending, the reduction of government employment, the reduction of incomes that will come from reduced labor, the reduced employment from government agencies, that's a negative to economic growth.
Yeah, I'm there, and I want to actually pull on that a little bit, but just the question I wanted to ask here is beyond DOGE, which I kind of think is sort of like yes, it makes total sense. And folks, you might disagree with the approach. You might not like Elon Musk. You might think the constitutionality of the approach is in question. I'm not trying to pick a partisan thing here. I'm just saying it's hard to argue against spending your money more wisely, right? Trump's other policies that, so like tariffs and stuff like that, which are basically designed to negotiate, to end up in better trade deals for America, whether the tariffs stick or not. Drill, baby, drill. Like the other parts of his economic platform, do those make you more or less bullish for the economy? And I'll say in the long run, you don't have to worry about the short-term impacts.
Right. So here, let me just share. So again, so let's just start with tariffs, and then we'll go through some of the other stuff, like drill, baby, drill is a good example. We'll get into that. But so we don't have a lot of history about tariffs. The only other point we only have two periods in history where we had tariffs. We were back in 1915, 80% of the entire government revenue came from excise taxes and tariffs. Only about individuals only paid about 5% of the income tax, so they weren't taxed very much at that point. But right in the middle of that period was the Great Depression. And that was because of the Dust Bowl and the Midwest and a whole variety of colliding impacts all at once that reduced economic growth.
Cascading bank failures. I mean, there's all sorts of things. Yeah.
Right. So we can look at tariffs back then and say, well, tariffs didn't really cause inflation, but you got to deal with that whole depression factor. So the only other period in time that we can really kind of talk about tariffs is during Trump's first term, when we had the trade war with China. And so let me share a couple of charts with you here. So if you want to read the whole article, it's on both Substack. I just posted this morning on our Substack channel, as well as it's on our website at realinvestmentadvice.com. But it's talking about tariffs, the tariffs and the impact on the economy. So this is during the trade war. This is the red line is CPI, the black line is GDP. So what you would expect is that when economic growth is growing, you're going to have higher rates of inflation, because inflation tracks GDP. It's economic activity, supply and demand. Remember, he got elected in 2016. So this starts so I started this 1 month before he took office. So I started the data at December of 2016. And of course, we were passing, the expectation in 2017, which was passed in late 2017, was the Tax Cut and Jobs Act. So a lot of expectations about tax cuts. So people were out spending money. It was great. Corporations were kind of investing ahead of tax cuts. And so we saw this boom in economic growth and inflation rose. But over the total term, now I ended this, by the way, at the end of 2019. So this excludes 2020 because that was kind of an anomalous event that had we not shut down the economy and started funding checks to households, et cetera, it kind of just really skewed the data. I mean, you had a massive drop in inflation and a massive drop in economic growth. So it really kind of skewed what was going on with tariffs and the trade war. So I excluded that one period just because we're talking about the impact of tariffs, not the impact of the pandemic. But so what you saw this period of time, though, is inflation actually trended lower as economic growth was trending higher. So tariffs didn't create inflation to speak of because consumers have a choice in terms of how they spend money. Secondly, is that tariffs actually did not cause a lot of job losses or anything else. This was one of the headlines that came out. It was like, oh, tariffs are going to lead to massive unemployment. Actually, during the entire time, we had growing economic growth and we had declining unemployment rates. We had one of the lowest unemployment rates in history during this term, before we got into the pandemic and laid people off because of the pandemic. So again, a lot of these narratives, don't really support that. But let's talk about the markets because this has been one of the areas that people really talk about. So this is the chart of the S&P and kind of the big major impacts of what was going on with the trade war with China. And despite the fact, so two things to really note from this. One, you had a whole lot of volatility in that market because of tariffs. And this is one of the reasons that we're a little bit more cautious this year on the markets because of tariffs. If we actually do start implementing tariffs, it is probably going to lead to increased volatility in the markets. We've seen some so far, but so far the tariffs have been just stick and carrot. It's been, hey, I'm going to tariff you if you don't do this. So it's all been about negotiations up to the standpoint and not any real tariffs. But if we actually start into a real tariff program, and he's alluded to tariffs starting in potentially as early as April, that is probably going to lead to some more increased market volatility because that's going to start to bring up concerns about earnings growth and economic growth potentially if those tariffs get implemented and how those actually occur.
Okay. Hey, don't leave that chart yet, real quick.
Oh, sorry.
Because I think that to the extent you think that is a good analog, which it sounds like it is, you see your trend line there, right? The dotted blue line is going up at about a 45-degree angle from the beginning of the data series to the end. But if you were to draw it in between those two gray dotted vertical lines between the tariff, it would basically be flat, right?
So and that's that yellow band that says trading range.
Right.
That was really that whole period of that middle. Right.
Right. So if you're, I just want to highlight this because I think you're saying you think probability is high enough that we might be entering a similar era that we should potentially be prepared for what happened here, where we basically had, what was this, a year and a half, where we went nowhere from start to end, but there was a ton of up and down in the interim.
Yeah, and it kind of that whole period kind of sucked. Now, part of that was in there too, is the Fed was hiking rates, so that certainly had an impact. And again, tariffs never were. There's no period in history you go look at and say the only thing that was happening in that period of time was tariffs, right? So we don't have that period. So we do have to factor in there were other things going on. The Fed was hiking rates. We were nowhere near the neutral rate. At the same time, we're doing a trade war. So there were certainly other factors that were leading into this. But again, it's just, this is the only kind of comparative period we can look at to where we might have, some ability to kind of say, well, kind of what's going on. This is the volatility index. And this really kind of shows you that this was a whole variety of tariff announcements, actual tariff institutions where he was actually instituting the tariffs on China. And there were certainly increases in volatility. So this really kind of goes back to that S&P chart, is that we saw volatility spikes on a regular basis during that entire period. And a lot of these spikes were directly due to tariffs. And so that's kind of a good, kind of measure to kind of expect. This chart just puts the two together. And so you can kind of see, that when these tariffs were getting instituted, we saw very sharp spikes in volatility as markets were trying to come to grips with what does this mean? How's this going to impact things? What's going to happen to the economy? And then markets quickly got over it. Volatility dropped right back to its lows and the markets took off again. So the real key, the lesson to take away from this is that tariffs are short-term implications. The markets will adapt to them very quickly. Tariffs are probably, and again, there's always the possibility, but probably are not going to lead to the next major financial crisis, where the markets are down 50%. But you could certainly expect a 10 or a 20% decline, like we saw in 2018. That would certainly be well within the cards. Again, something that potentially we expect sometime during this year, maybe this summer, you see a 10, 15, 20% decline because of some, impact of tariffs, retaliation, et cetera, that causes some disruption in the economy, right?
Got it. And I think you could also say too, from here, you can learn from here that tariffs cause the VIX to spike, and that creates short-term market disruption when it does. And we are coming off several years of the VIX basically looking dead, right? So like the market participants have kind of grown complacent that the VIX isn't something to be worried about.
Right, and they should be worried about it because the VIX tells you a whole lot. But I want to bring up one more point here about tariffs because this is where tariffs are the most important. Consumers have choices, right? So if I am putting a tariff on apples as a consumer, I'll just go buy oranges, right? So that's why tariffs don't lead to inflation. But where tariffs do impact, and the most important impact on markets is on earnings. And I'm going to show you a chart here real quick. I posted this on Twitter this morning. S&P just came out on the 11th and published their estimates for 2026. They're now expecting S&P earnings to be $289 a share at the end of 2026. That is up from $249 a share for the end of this year. We are currently at 209, and we just basically finished the fourth quarter. We're just wrapping that up. We're at 209. So they're expecting massive earnings growth. That dotted green line is the historic 6% peak-to-peak growth trend in earnings. Why is 6% important? Because that's what the economy grows at historically over time. Earnings can't outgrow the economy. So if I'm imputing tariffs on somebody and it slows economic activity because of higher costs, then your economy is not going to grow at that rate. So right now, earnings expectations are exceedingly above what the economy can actually generate, these expectations anyway. If the long-term trend growth of earnings is $195 a share, so almost $100 less than where current estimates are, is the long-term trend growth in 2026. Now, this is the deviation of those earnings from the long-term growth trend. Historically, whenever you've had big deviations of earnings from the underlying growth trend, that was either the peak of the tech bubble, the real estate credit bubble, liquidity bubble, pre-COVID, post-COVID, and now we're at a level higher than any other point going back to the 90s in terms of earnings expectations. So the reason I bring this up is going back to tariffs, because where do tariffs have an impact? They have an impact on corporate profitability, right? Because here's the thing about CPI and PPI this week. What did that tell us? What PPI told us on Thursday is that corporations are unable to pass on all of their input costs to consumers. Where do tariffs show up? Tariffs are not paid for by consumers. Tariffs are paid for by the producers. If the producer can pass on that tariff to the consumer, great. The consumer pays for it. But that 25% tax on steel or aluminum or whatever is paid for by the company that's buying that aluminum or steel and having to pay 25% more for it. I only hope I'm the guy that's making the cans for White Claw that I can make my cans and sell them to White Claw for 25% more than I'm sure White Claw makes their own cans, but I'm just hoping I can pass that 25% on. What PPI told us this week is they can't. And this is the important thing about this chart you're looking at here on the screen right now. That is the S&P trailing reported EPS. It's the 3-month rate of change in earnings. What you'll notice is that when Trump was talking about and instituting tariffs, it was all fine after that first escalation. But as the tariffs actually started impacting, earnings growth began to decline because companies couldn't pass on that tariff to the consumer and it began to erode their earnings. And that's so you take a look. So the thing we've got to watch on is we got these massively high earnings estimates that are justifying paying 35 times earnings for stocks. If that earnings estimate begins to come down sharply, which it will, by the way, when that comes down, that is going to impact the valuation issue and make markets start to reprice what they're paying for forward earnings. And that's where you get this volatility pickup in the overall markets.
Okay. All right. I'm really glad we had this discussion. We totally violated my let's keep this to a couple minutes goal here, but that's okay. So I'm going to jettison a couple things, push them off to next week, including our talk about unemployment and what a world of 80% unemployment would look like if Rubini was proven correct.
I definitely want to have that conversation with you. So let's just make that the starting talk next week.
All right. So I'm earmarking that. And really where I wanted to go with it is less, are we going to be living in an 80% unemployment world in 20 years, but more just sort of in the here and now, what type of advice would you have for, the average person who's working for a paycheck here? Because it's as we talked about earlier, it's already getting harder for them in the near term, right? But you and I have talked a lot about younger people starting off as well, and it's a different world for them for sure. But I think it's even a different world for somebody who's mid-career, right? Or at least needs to work for the next 10 years, where I hate to say this, but the power structure may be swinging more and more towards the employer as jobs get more scarce, right? But we'll dig into that next time.
Yep.
So let's see. The only other thing I want to say about what we said earlier is, you were talking about DOGE, if it actually does make some changes on the deficits. And I agree that I think even if DOGE just keeps the deficits flat, liquidity works its wonders when it's increasing. When the impulse is even just zero, doesn't even have to shrink. It doesn't lift up anymore, right?
Right.
So we've got a risk of kind of we have an economy and markets that are addicted to liquidity right now. I think that's probably pretty easy to say, right? So anything that threatens that liquidity threatens to throw either or both of those things into some sort of withdrawal shock, right? Depends on how big it is, but that's the threat out here. What's interesting is, it's not representative of the country, but I put out a poll on X that actually got a lot of 5,000-6,000 respondents, where I basically put out the hypothetical question that if DOGE, the government, could find an annual savings of $1 trillion, but the cost of it was a recession in the short term and a 33% or 30% market correction. Would that be an acceptable price for you to pay? And it was like 90%, I think over 90% said yes, right? And the point is I think Americans are at the point where they're sick of the inefficiencies, they're sick of just this wanton spending, rising cost of living for everybody, and the benefits of it going to those who have assets, right? So it's like, the majority of us are getting the pain of it, but not the benefit, and then there are other people out there who are getting a lot more benefit than pain, right? So I think people are constitutionally ready, mentally constitutionally ready, to say, look, I'm willing to kind of tighten my belt a little bit. I don't love it, but I'm willing to tighten it if it gets us back to a playing field that's a little fairer, right? And
Yep.
that heartens me a little bit, and I'm rooting for DOGE to find better ways to spend our money, as you were saying earlier. My advice to Trump, if he were listening to me, would be like, wrap that into the narrative to the country right now that, look, there might be some knock-on effects from what we're doing here, right? Because I like you, think that there's going to be some short-term disruption in the economy and probably in markets as a second-order effect of this. And, you know, if they're bad enough, you know, maybe the Republicans kind of suffer in the midterm elections. And so I would be trying to take advantage of the sentiment right now that like, hey, we're cleaning house. We're gonna have to rip some band-aids off. We're gonna have to break some things to rebuild them, which I think most people think is the right thing to do. So why don't we just make that the national priority here? And you know, hopefully deliver on it, right? So, anyways, we could talk more about that later. But I thought it's interesting that, you know, when I wrote the poll, I probably figured people would be net for it, but I didn't realize how net for it they were. And even though it's my audience and it's not a representative sample of the country, I don't think it's that far off.
No, and look, I mean, a lot of the other polls are kind of showing the same thing in a lot of cases. I mean, if you kind of look across general polls about approval ratings and those type of things, you know, so far everybody's kind of for it. So
Yeah. Yeah. And yeah, a little more. This is something for us to talk about later on. But like when you think back to times where the nation really rallied behind kind of the greater good, you know, whether it was protecting democracy by getting involved in World War II, whether it was, you know, building out the national infrastructure, you know, after the war, whether it was getting behind the country in the space race, you know, that type of stuff. Like Americans, they're we respond to calls to greatness, and I think we all, you know, realize that if we make things better and fairer, it's going to provide dividends for all of us. But there's a cost to that, and I think we're constitutionally aligned, or yeah, we're constitutionally aligned with kind of making a short-term sacrifice in the long time for a greater good. I just don't think we've been called to exercise that for a long time. And I think some of the maybe the calls that have been out there have sort of been false ones. And so we've sort of felt taken advantage of. So we don't trust it anymore. We've gotten lazier and softer as a culture. But I think, you know, our future prospects, you know, are maybe more than a little bit dependent on us finding that again, where it's leaders that can give us a good cause to get behind, but then also us, you know, getting off of our couches, putting our phones down and saying, yeah, I'm going to be part of this, and being willing to take some short-term pain, you know, rather than just, you know, at
well,
the first whiff of whatever, you know, crying for help.
yeah, and that, you know, that's something I said before is that, you know, if I was President Trump, my first day in office would be, you know, hey, this is what we've got to do. We've got these problems. We're going to go tackle them. Just be aware it's going to probably hurt the stock market. It's probably going to hurt the economy a little bit because we're going to be, you know, cleaning house. But once that's over with, we'll be in a much better position to go forward. Just, and again, I would have been very clear. You know, we did do it, but, and I'm not the president, so it doesn't matter. But I would have been very clear and explicit that, hey, you know, this could cause some pain. Be prepared for it. And I think if you did that, and again, because the rally cry should have been, hey, I need your help. You know,
Right.
we're going to have to fix a lot of things. And before I ask you to sacrifice, we're going to sacrifice in Washington. We're going to cut spending in Washington. We're going to cut, you know, excess, you know, labor and all this other stuff. We're going to clean house in Washington, get our house in order here. And then I'm going to come to you and say, hey, you know what, you know, I need to institute tariffs or whatever it is. So that's going to be a bit of a burden on you. But, you know, I think if he had approached it from that direction and used that kind of national cry, so to speak, to say, hey, look, help me help you, you know, then you'd have a lot more support behind it.
I agree with that. And I actually think that is a mistake right now. I think that's a communication mistake that may come back to
Yeah.
haunt the administration. All right. I've got a rant, which we can keep pretty quick, and then we'll wrap it up real quick before we get to the rant. Trades. Sounds like you guys have been doing some gardening.
Yeah,
Anything else
nothing major.
noticeable?
Yeah, no, nothing major this week. You know, we did just a little bit of trimming, and I'm just pulling it up right now just so I can tell you exactly everything I did because I can't remember. I've slept since then. So, but basically, we trimmed Costco, Walmart, and AbbVie. Those had gotten very overweight in the portfolio. They've had huge runs, particularly Costco and Walmart have just been on a tear. So we just basically trimmed those back to all three of those back to target weight. Now, the next kind of phase of the portfolio will be to go in and start looking at positions that we're either underweight in or overweight in terms of where we want them to be. Again, they may be at target weight right now. Say a good example, AbbVie makes up 5% of our portfolio. Costco makes up 4.5% of our portfolio. So those have been providing a lot of alpha to the portfolio because they've been doing well. But we may look next to adjust those target weights. So we say, okay, we don't want AbbVie to be 5% of the portfolio. We want to reduce that to 4%. And so we trim it there. So the next phase will be look to rebalance the target weights in the portfolio to help the portfolio reach what we call the beta, or its relative volatility to the market itself. So, what we like our portfolio to do is if the market's up, 1%, we want to try to be up, our benchmark is up 1%. We want to be somewhere around 80%, of that. If the markets are down 1%, I want to be around 20% of that decline. So we adjust that. So the purpose of adjusting the target weights is to adjust that beta relativity to our benchmark, so we can measure and monitor the risk better of how the portfolio performs.
All right, great. Okay, well, look, getting to today's rant, I've been posting some videos on X recently about some of the things that I've been doing to kind of push myself in other aspects beyond just thoughtful money. You and I have talked about this strength training program that I've been in, and it's designed that these are 4-week cycles, and the third week you work up to your heaviest lift of the 4-week cycle, and then the fourth week is you deload and you recover and all that stuff. But your last lift in this third week is your heaviest lift of the cycle, and you want to be safe in how you do all this stuff. But the intent of the heavy lift is to put the most amount of strain on your muscular system so that your muscles grow, and when you start the next cycle, you hopefully have a little bit more muscle mass than you did when you started the previous one. And where I'm going with this is, yes, so much of all this is following a program that gets you stronger and stronger so that you can make that heavy lift. But so much of that heavy lift is not just your physical strength and ability to pull it, it's your mental strength, right? It's this sense that, like, I actually can lift this weight that my mind is telling me that is a really freaking heavy amount of weight. You can't lift that, right? The other thing I did this week was I started cold plunging again. And I think we talked about this once a year or two ago, Lance, right? And I mean, that is the last thing in the world your brain wants to do. Walking into that cold water and staying in it, your brain is just trying to claw its way out of your skull. It does not want to be there, right? And there are presumably a lot of health benefits from cold plunge. I know from having posted on X, people have lots of opinions about it, pro and con. I will say it does really appear to help me. But one of the benefits for sure you get from it is just being able to build your mental fortitude. And where I'm going with all this is that willpower is a muscle. It's something that you have to train. If you don't, you're much less likely to push yourself outside of your comfort zone. And when you're trying to make progress in life, the way you do that is by pushing out of your comfort zone and doing things that you're not necessarily sure you're going to be able to do when you start them, right? And a key part of that is this willpower development to say, you know what? Yeah, I might not fail. I'm not entirely sure this is possible, but I'm gonna go for it, right? I'm gonna see what happens, right? And worst case scenario is you fail, you regroup, right? You try to figure out if there's ways to improve and do it differently the next time. And my general point is, I think way too often we just sort of let ourselves get stuck in our routines. More importantly than anything, I think we just get comfortable with comfort, right? We comfort in many ways is the opposite of progress, right? And so this intentional act of pushing yourself out of your comfort zone, trying things you're not entirely sure you're going to be able to do, is, I think, critical if you want to end up in a better place than where you are right now. So where I'm trying to go from this is, what I'm trying to instill in this is this sense, maybe a little bit of a call to action to folks, is to say, hey, what are some things you'd like to improve in your life? And can you pick a few things where you're going to really leverage that willpower and say, I'm going to try something I haven't tried yet, and I'm not entirely sure it's going to work, but this seems like a really good potential way to go from where I am now to someplace better. And Lance, I know a lot of your life, whether it's been starting businesses or being an MMA fighter or being a successful a manager of clients' assets and fighting the stock market, if you will, as an analogy, that willpower has probably played a tremendously important role in your trajectory.
Yeah, no, it has, and again, it's just it's easy to, just get into like a groove and not innovate, not do anything. But like one thing we've been building for the last, year or so is the Simplivisor platform, which is this digital platform. Well, the next innovation of that is, you know, going to be an AI generated platform that's all using AI to basically manage portfolios and do that type of thing. And that takes, that's just, we're having to just make this whole kind of shift in that direction. Starting a private credit fund is, kind of a new innovation. So we're going through that whole exercise. But these are things that just, you know, take a lot of time, take a lot of focus. And it'd be a lot easier if I just said, hey, our business is fine. I don't need to do anything. And we'll just sit here and just keep doing what we're doing. That's certainly doable. But the market's changing and the world's changing and things are going in different directions. So we've got to keep innovating, keep growing, and that presents challenges. And that also incorporates a lot of risk because again, you spend money, you make outlays to do this type of stuff, and it could fail miserably. So, those are the risks. But same thing with working out. Things that we need to do to be healthy, those also take willpower, eating right, exercising. And, this is one thing I talk about a lot is that I have a very strict calendar, and every day I'm at the gym at a specific time, and don't mess with my gym time. You can mess with any other part of my day, just don't mess with my gym time. And there's a lot of day. Thursday was a good example. So I went to the gym. I did not want to work out. And, I got there and just, I'm just going to do something, right? I got to do something just because I'm here. And then once you start doing something, then it's easier just to go ahead. Okay, I'll get my workout done. Now it was a crappy workout at the end of the day. It was a crappy workout, but I got the whole thing done. But it's just the function of forcing myself to do it. And then after it, I felt great. I was like, okay,
Right.
I did something. I achieved the goal, and that's good. And I think that's really the biggest thing, Adam, with all of this. Whether what you're doing or kind of the way I approach things is, I was watching this video about SEAL training, and they start out every morning. First thing you do is make your bed, and it's not the function of just making your bed; it's the function that you get out of bed and you accomplish something right off the bat. So you've already accomplished something for the day, and that just helps start your day. Whatever it is, and this is so doing those type of actions, just taking some initiative to do something and making. And again, to your point, when you don't want to do something or you're uncomfortable doing it, that's the thing you've really got to push through. If it's something that is going to lead to a better outcome, now don't go do something you're uncomfortable to do if it's not going to lead to a better outcome, right?
I'm going to hit myself in the face with this hammer. Yeah, no,
exactly, right. So yeah, I don't want to do this, but I have to. But yeah, I mean, but that's how we improve, and that's how we achieve success is by pushing ourselves. And when you reach a level, that's the you have a choice, either be complacent at that level or to push yourself to the next level. And that's the one thing that frustrates my wife because I'm never happy. We get to a certain level and I'm like, nope, got to do more. And she's like, can't you just be happy there? No, I got to do more.
Yeah,
I got to buy another gun.
So agree with everything you're saying. And again, to my point, like it is a muscle, right? So like the more that you get comfortable and repeat, pushing yourself through discomfort to get to somewhere better, the easier it is to do, right? It applies to everything in your life. And if you don't develop that, and you never get off the couch, right? It becomes really hard to do anything different than the routine. And where I'm going with this too is, yes, this is all good for advancing where you are in life, right? So you should want to do this just for self-improvement. But even if you don't, even if that's not really calling to you, right? There is a danger, as you said, Lance, with staying in the status quo, right? Which is the world is dynamic, the world is constantly moving, right? And you may you may find that the world kind of passes you by while you were just there in the stasis of your comfort. And a good real world example of this is, in these 2 million government employees that basically were just told, hey, here's a buyout. You better take this one because the next offer is not going to be as good, right? Where these are, government employees who, and I'm painting with a super broad brush here, folks. I'm not trying to insult anybody. But a lot of them probably got complacent. I got a government job. It's here for life. It's not that tough, hard to get fired, all that stuff. And all of a sudden they're realizing, whoa, wait a second, I'm going to be out in the competitive job market here. Can't get hired again by the government. Um, wow, like, a lot of them might realize that they, have the market demand for skills is not a fit now with where they got nice and cozy in their long-term job, right? You're nodding as I'm saying this, Lance. So, there's also like a self-preservation, element for this as well. So just to wrap it up here, my call to action for folks watching here is, start trying to exercise that muscle. And a good way to do it is just start to find some things that you would clearly make your life better off, whether it's a workout or whether it's, a cold plunge or whether it's a new skill that you think you should learn for your industry or whatever. And, intentionally say, look, yeah, I could just chill here, like I normally would do, but instead I'm going to use this time and try to use it productively to advance my station here. And then to your point about the workout, once you get that momentum, keep it going, right? Find out what other things you can apply it to.
Yep, exactly.
All right. Okay. Well, look, if you think one of the best ways to work on your willpower and improve your station in life is to continue watching Lance Roberts on this channel week after week after week, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Reminder, well, first off, we've talked about how this year may look quite different than previous years that everybody's gotten used to investing wise. If you'd like some help in figuring out how to navigate your wealth through that, highly recommend that you work with a good professional financial advisor, and certainly one that understands all the issues that Lance and I have been talking about here. If you've got a good one, great, stick with them. But if you don't, or you'd like a second opinion from one who does, feel free to schedule a free consultation with one of the financial advisors that Thoughtful Money endorses, perhaps Lance and his team there at RIA. To do that, just go to thoughtfulmoney.com, fill out the short form there, and the firms will be in touch with you right away. While you're there at thoughtfulmoney.com, don't forget to go to thoughtfulmoney.com/conference and sign up for our spring online conference that is now just a month away. As a reminder, that's Saturday, March 15th. If you cannot watch live that day, don't worry. Replay videos of all the presentations, all the live Q&A sessions will be sent to everybody who registers for the conference right after the conference ends. A reminder that we are still offering, I think for just the next couple of weeks, we're still offering the early bird price discount, which is the lowest discount we offer, but that's going to go away relatively soon, folks. So run, do not walk to thoughtfulmoney.com/conference and buy your ticket now. And a reminder, if you are a premium subscriber to our Substack, you get an additional $50 off the ticket price. So right now you're going to get an additional $50 off of that lowest early bird price. All right, Lance, my friend, it's great to have you back. It was wonderful to have Michael here, but it is good to have the prodigal son return. I'll give you the last word as usual.
Well, if you'd rather have Mike here every week, just let Adam know in the comment section. Give me a vacation. So.
Now, there are a lot of Mike fans here, but Lance,
That's great.
Nobody matches Lance.
And he is well deserved. He is a very, very smart guy. So I'm very, very blessed to work with him. So it's a great thing.
Yeah, and so to interrupt it, just speaking about, we talk about workouts and stuff like that. When I hung out with Michael in Houston, I learned that he's actually, fitness is a pretty important part of his life as well.
Yeah, look, look, at the end of the day, it's you look at really successful people, they generally always have fitness as one part of their aspect of their life, somewhere it is. It doesn't have to be like they're not gym rats, right? But they're getting to the gym, they're taking walks, they're running, they're biking, whatever. They've got some sport that they do because it clears the brain, it increases your mental capacity, it gets your blood flowing. And not just to mention all the health benefits, but it really helps clear your head so you can focus on problems. And that's the thing that generally we're all trying to achieve is we're trying to get from one level to the next. Well, to get to that next level, there's generally a problem in between that we've got to resolve. And sometimes, getting away from the problem is the best way to solve it because you get to the gym, you're working out, and all of a sudden it's like becomes very clear. It's like, oh, I just need to do this and I can get past that problem and move to the next level. And so when you ever look at somebody that's really, really successable, there's generally some aspect of fitness kind of somewhere in their life.
And also, too, to me, it's a sign that people really, those people really understand what true wealth is. And we talk about this all the time on the channel. Money is a means to an end. It's not the end of itself. It's quality of relationships, purpose, and health. And these people are very much realizing, yeah, I deal in the world of money, but what's really important is investing in my health, giving my life purpose, and taking care of the people that I care most about.
Absolutely.
Yeah. All right, my friend. Well, another great week. Look forward to picking up, with some of these topics right off the bat next time. But glad to have you back, Lance. Everybody
All right.
else, thanks so much for watching.